so financial management, FIN3701, support material 4, that's the notes we're looking at. Just to go through the learning outcomes for the first bit, which is the cost of capital. That's something to consider here, cost of capital. When you see that word, what are you thinking about?
What it's going to cost you to finance a project or something.
Exactly. Okay, so finance is the focus. Where are you going to raise it? And we know from our previous module, okay, FIN3601, how can you raise capital?
Through loans?
Or?
Selling shares.
Yes, okay, debt or equity, good. So in this section, we're going to be focusing on the costs. Do you agree companies can choose how much debt and equity they want to use? And the cost will then determine, okay, whether a project will be accepted or not. So from an accept or reject point of view, okay, we've looked at this in the past where we've had accept and reject criteria around NPV, IRR, payback period, and so on. So if I'm just focusing on cost, do you want the cost to be greater than or lower than the IRR?
Lower.
Correct. Okay, so you want to keep the cost as low as possible, and you want to try and maximize the return. Does that make sense?
Mm-hmm.
Okay, so when calculating cost, you're going to have to look at two components, the debt and the equity. Then you've got this extra consideration, which is the pref shares. Is that debt or equity?
Equity.
It's actually both. It's quasi-debt because it's similar to debt and also similar to equity, and we'll explain why a bit later. Okay, so those are the different components that you're going to be looking at in terms of establishing the costs, because when accepting or rejecting projects, you're always going to have to consider the risk, which is the cost. So if the project is going to cost X, what sort of return are we going to get? If the return outweighs the cost, then we're creating value. And remember, the focus is always on value, creating value for our owners, our shareholders, the people owning the business. So we need to recap one or two things from last week. We looked at refinements. Do you guys remember how we refine NPV?
No.
There were two refinements that you could use to make the actual valuation, okay, more accurate. And what were they? Do you remember, Carl?
No, not really.
Okay, think about what do you need in order to create an NPV or to calculate an NPV? What do you need to calculate NPV? Cash flows? And?
Okay, I suppose so. Okay,
what else? Cash flows and the what?
The interest.
Yes, the rate, correct. Okay, so when looking at capital budgeting, you're focusing on what do I actually have in terms of the expected cash flows, and that's chapter 1, okay? Creating the NPV from INV, initial investment, OCF, operating cash flow, and TCF, terminal cash flow. So those were the cash flows. And those cash flows can be adjusted based on risk when you have something called a certainty equivalent. Or a probability, a percentage. So all the cash flows aren't going to be certain. Okay, we're not going to know exactly what the cash flows are going to be in the future, but we can make an estimate. So how certain are we about the first cash flow, the initial investment?
No, we're always certain that it'll be outflow.
Okay, you're definitely certain about that. So there's 100% certainty assigned to that cash flow. But the cash flows that occur later, are we more or less certain about those two?
We're more or less certain.
We have an
Not
idea,
100%.
but how accurate are we?
Not 100%
Not
accurate.
100%, yes, that's good. So it'll be less than 100. Okay, so when looking at a refinement, you can either adjust the cash flows or you can adjust the rate. What did we call the rate that we adjusted?
The interest, interest rate.
Yes, so if we adjust the interest rate, what does that give us?
It gives us higher or lower MPV, depending on how we adjust.
Correct, based on risk. So the risk-adjusted discount rate provides for risk in the calculation. And that's part of the refinements. Is that all right?
Yeah.
Great. Okay, so there were other methods in terms of analysis. You could have looked at scenario analysis, where we looked at different scenarios. And scenario 1 could be recession, scenario 2 could be normal, scenario 3 could be boom. Okay. What is a simulation?
Sorry, say that again.
Okay, who wants to try? You both were saying something?
I said I can't remember.
Oh, you can't remember. Okay, so what did you say, Carl?
I actually didn't hear the question.
Okay, what is simulation?
Isn't that when we look or we compare both projects and see which one might be more beneficial?
Okay, well, that you would do for all the different, let's say, criteria in terms of calculation. So you would do that for net present value, you would do that for internal rate of return, you would do that for payback period. Simulation is trying to combine more variables. Okay, so we don't only have two variables in terms of cash flow and interest rates. We're trying to build in more components to create a model that's more accurate of what's actually going to happen. Okay, so simulation is focusing on a multi-variable type of situation where you're considering lots of different components. Okay, so always remember which is the better measure. Which is the best approach?
NPV.
Always. NPV is the best because it takes reinvestments into consideration. So when will you have a reinvestment? Non-conventional or conventional cash flow?
Conventional.
Non-conventional. Because conventional, you have the outflow at the beginning and then inflows throughout the life.
Yeah.
Non-conventional gives rise to future outflows. And if you've got future outflows, that's seen as a reinvestment. Is that okay?
Yeah.
Alright, so just remember, if the initial investment is negative and you've got other amounts later on, let's say you've got another negative there. Okay? This negative and that negative both relate to the same project. So now, if I'm working out IRR, is IRR going to look at that, or is IRR going to look at this? See, that's where the problem comes in, because we're not too sure what are we actually receiving from the project. Okay. Right, so here's the note about risk-adjusted discount rates. When do we adjust the rate? We adjust the rate when we can't measure certain things. So, can you measure political risk?
Sorry, what did you say?
Can we measure political risk?
I think so.
Sure.
Political risk, can you measure it?
No.
No, we can't
Not
measure
really, no.
political risk. Can we measure economic risk?
No.
No. Okay, so there are certain risks that you can't measure, or even geographical risk. So working in one country versus another. Can you measure that risk?
No.
No, we can't. Alright, so with the risk-adjusted discount rate, we're looking at bringing in other factors, and they're normally external. So depending on where we're operating, if I operate in SA versus operating in Zimbabwe, okay, there is a risk, there is more of a risk in the one country versus the other. Okay, for different reasons. It could be location. Okay, so Zimbabwe is a landlocked country versus South Africa, which we have the coast. Okay, so we have access to better transport than they do in terms of ports, okay, and ships. They don't. So obviously, from a business point of view, operating in one area versus another would provide certain benefits and certain disadvantages, and that creates a risk. So when do I increase the risk? When there are factors that will give rise to more uncertainty. So when I increase the RADR, I'm providing for more risk in the calculation. The bigger the risk, the bigger the RADR. So if the RADR is bigger, what's going to happen to your NPV?
To go down.
Lower.
Correct. It's going to decrease. So if it decreases, are you going to be accepting more or less projects?
Less projects.
Correct. You'll be accepting less projects because you're assuming, right, the return is going to be lower because you've got a higher rate in terms of your discounting. Okay, do we need these fancy equations?
Not really.
No, we don't. Okay, because you have the calculator that can do it for you. Right, all we need to do is interpret this. So what does this equation say? This equation says take all the cash flows, all right, from time period 1 to time period n. Okay, so T0 is there, T1 is here, Tn is there, right? So the first bit, this summation sign, okay, tells us to sum up this cash flow from 1 all the way through to Tn. Okay, and they tell us to discount it back in time at the risk-adjusted discount rate. So literally take all those cash flows, move them all back in time, and that gives us what? A present value of our future cash flows. That's what you're doing here. Present value of your future cash flows. Does that make sense?
Yeah.
Okay, and then what cash flow do you have at the beginning?
Initial investment.
The initial investment, exactly. Right, and if I take the one and I subtract the other, what do I get? What do I get?
The proceeds.
The net present value. Okay, so what I've written in green here, that's the first bit. The red is the second bit. If you take present value of your future cash flows minus your initial investment, you land up with
NPV.
NPV. Okay, that's how you calculate NPV. That's what the calculator is doing for you. Happy?
Okay.
Alright, so the introduction, we spoke about cost of capital earlier. Okay, so now we need to expand a bit more on what does that actually represent. Okay, so we know cost of capital is what the actual project is going to cost us in terms of our initial outlay. Okay, because we spoke about resources. Are resources limited or unlimited?
Limited.
They're limited. So you may or may not have to approach external providers of capital, debt or equity to run the business. When talking about market value or market cap, we're looking at the company's worth. Okay, so how much is the company worth on paper in terms of all its assets and liabilities? Okay, so owner's equity we know is A minus L. When looking at cost of capital, which component are we looking at? The OE, the A, or the L?
It'll be OE.
Yes, OE is one component and
L.
yes.
Yeah,
Okay, because it's debt and equity. Right, so see, this is more of the financing. Okay, because before you guys have done accounting, so you guys are familiar with assets and liabilities, owner's equity, the basic accounting equation. When focusing on owner's equity, we're looking at the cash, okay, that they're getting from owners, okay, shareholders. And then when we look at the L, that's focusing on the debt. Let's look at the loans, the borrowing. And obviously the two are going to be used to finance what? Our assets. Okay, so have a look at that. assets are financed either through debt or equity. Does that make sense?
Yeah.
Okay, so just think about basic accounting equations. A equals OE plus L. That's how you buy assets. You purchase assets, either through debt or equity. Okay, so risk is held constant, then the rate of return must be greater than the cost of capital. Why?
So that you're able to get some money back, or that you start making a profit.
Correct. Okay, so the reward is greater than the risk. And that increases value. And if you're creating enough value for enough people, okay, that business will become profitable. Okay, successful, yes. Right, so what is the recommended criteria then? What am I going to use to represent the rate of return?
Sorry, I can't hear you.
What is going to be used to recognize the rate of return?
NPV.
NPV is a measure of value. What are we going to use? Think about it. Rate of return. IRR.
Is it right?
Okay, IRR is this, the rate of return. Okay, cost of capital is the risk. Right, you mentioned NPV. That's fine if we're looking at discounting those cashes back in time, where we're considering the actual value that's being created. Okay, if we're just focusing on this, the rate of return and the cost of capital, it's the IRR that we're going to be looking at, because IRR is what the project actually gives us. Do you guys agree?
Yeah.
Yeah.
Okay, so do you have your calculators close by?
Mm-hmm.
Okay, we're going to be using them quite a bit today. Quite a lot of calculations, a little bit of revision as well. So if you guys are fine with bond valuations, okay, that was something you covered in FIN3701. And if you're okay with share or equity valuation, then this section is easy. Okay, because then you should be able to do the basic calculations. It's just a few things that we need to do more in terms of getting the actual cost of capital for the entire firm. Right, so do you agree we're not going to want to look at the cost for one component? Okay, we want to know what the cost is for the company. Okay, because the company uses both debt and equity. Do you agree?
Yeah.
So if I know what the cost is for debt and I know what the cost is for equity, I can combine the two to get a cost of the company, the cost of the company's capital. Make sense?
Okay. Yeah.
Okay, so there are always some assumptions that we need to make, okay, when dealing with cost capital. And the reason for this is we're focusing on the debt, and the debt is going to create interest. Okay, is interest good or bad for the company?
Good.
Interest on debt.
It's bad because you have to pay.
Correct. Interest needs to be paid. Right, so if we're
But isn't
going
it
to be paying...
deductible on your?
Sorry, what were you saying?
But isn't it good because it's deductible on your income tax?
Okay, that's correct in terms of being deductible. So debt would be better than equity because you can deduct the interest. All right, but interest creates more risk for the business, because as a business, I need to pay the interest. So do we have more or less of an obligation to pay?
More.
Correct. Okay, so here we're looking at the assumptions around operations. Okay, so business risk. Right, the risk of being unable to cover operating costs is assumed to remain unchanged. Accepting projects does not impact the firm's ability to operate. Okay, that's the first assumption. Right, so when we're looking at cost of capital, if you decide to use more interest or equity, does that affect your ability to operate?
No.
No. Okay, in reality it will, but in terms of theory, we're going to keep it constant. Okay, because if we don't, then you're going to have simulation, which is looking at a multivariable approach. Okay, we're not going to look at multivariable approach in this particular module. We're just keeping it simple. We're focusing on what can I control in terms of my decision making and what impact will we have in terms of the cost. Alright, so just remember that if I take out more debt or if I sell more equity in the business, if I raise more capital, raising more capital isn't going to affect your ability to operate. That's the first assumption. Is that alright?
Yeah.
Yeah.
Good. Then the second assumption is this: financial risk. So financial risk focuses on that, the debt, the interest. So risk of being unable to cover financial obligations is assumed to remain unchanged. So projects that are financed in a way that will not affect firms' ability to meet their costs. So what does that mean? Well, that means if you have more debt or you have less debt, you will still be able to finance it, meaning you will still be able to pay for the interest. That's the second assumption. You guys okay? Makes sense?
Yep.
Okay,
Yeah.
so just remember, when looking at cost of capital, we're keeping two things constant: the firm's ability to operate and the firm's ability to meet its financing costs, i.e. its interest. So it doesn't matter if we have less interest or more interest, we can still pay for it. Is after tax important?
Yes.
Why? Why is after tax relevant?
I don't know. I took a guess.
You actually gave us the answer earlier. What were you talking about? What were you talking about earlier,
No.
Tammy? It's still up here.
The interest.
Yes, and what about interest? You were
It's
telling us that
deductible.
interest is good because you can deduct the expense.
Yes.
So if I'm looking at after-tax costs, why do I look at after-tax cost of debt and not before tax?
Because it's deductible after.
Yes, okay. Interest is tax deductible, so the cost of debt is higher or lower than it actually is.
Lower.
It's a bit lower. That's correct. Okay, because think about this. If you had to go to the bank and take out a loan, and let's say the loan was at 10.5%. If that's the actual loan in terms of the interest that you're incurring, if you're a business, this is the before tax cost. What would the after tax cost be? Higher or lower?
Lower.
It would be lower because we're taking out the tax. So 10.5 would then be multiplied by 1 minus the tax. Okay, because of what you said earlier, interest is tax deductible, which reduces the cost of borrowing. And that's why companies prefer debt over equity, because debt is a way to claim a deduction against your operational expenditure, okay, or your operations, your income. You guys still with me?
Yeah.
Okay. So, what is a target capital structure? It's looking at the optimal level of operating in terms of your debt and your equity. So, are companies going to target a specific capital structure?
Yeah.
Why?
Well, companies work according to targets. If you don't aim for anything, then it makes it quite difficult to either waste money or to lose track of everything.
Perfect. That's brilliant. That's good. Okay, so you just gave the answer in terms of the target. So companies need to target something. So if they're targeting something here in terms of capital structure, okay, a company will have a targeted debt and equity ratio. So it could be maybe 50-50. Or it could be something like this. Debt, equity, 70-30. Right, so now, how are those two companies different? What's different, guys?
Well, the one will have more debt than equity.
Okay, so comment. If the one has more debt than equity, what does that tell you about the business?
That it's not doing as well as the other business. The one with 50-50 is doing a lot more better.
Okay, better in
companies are
what
stronger.
context though?
Well, if it's 50% equity, then the business is able to pay for its partly pay for its own projects. Whereas the one with 30, you can see it needs more debt than because it can't pay fully.
Okay, you're on the right track. So for a company to use more debt rather than equity, what does that mean in terms of their strategy?
They're able to meet their obligation.
Okay, and if they don't, is that more or less risky?
More risky.
It's more risky. Good. Okay, so risk is a consideration. Right, you guys know that there are different perspectives around risk. You can either have a high risk, medium risk, or low risk in terms of your perspective. Okay, so if you're more conservative, are you going to be using more debt or less debt?
Less.
Correct. And if you're more aggressive, are you going to use more debt or less debt?
More.
More. Okay, so do you agree your view in terms of risk will determine which forms of capital you'll be utilizing in the company?
Yeah.
Okay, and that's a consideration because companies will decide on how much debt and equity to raise. And that communicates their level of risk taking. So if it's more 50-50, then it's equal. Okay, in terms of what the shareholders are providing versus what you're taking out in terms of loans. So if you see the trend change, meaning if you're going to have a focus on debt rather than equity, you can safely assume that the company is being more aggressive because they're wanting to expand by taking out more loans or by taking out more credit.
Okay.
So which company is better? The company on the left or the right?
Company on... It's... I don't know, you're going to have to work it out.
You're going to have to work what out?
The average... weighted average cost.
Okay, the weighted average cost of capital. Okay, that comes later on. Okay, you're going to have to work out the cost of capital. So even though this company uses 70 debt and this company uses 50, what is the cost of its capital, irrespective of where it comes from?
The one is 50 and the one is 70.
Yeah, it doesn't matter. So the point I'm trying to make here is it doesn't matter where the capital comes from. The big question mark is how much does it cost you? That's the key. Okay, do you know what the capital costs? All right. So, for example, if you take out a home loan, what sort of rate are you going to get on that? What rate, guys?
8.
Would you get prime, or would you get close to prime, or would you get a lot higher than prime? What are we going to be getting there? What's the actual cost?
Actually not sure what home loans are at the moment.
Okay, well, the rate would be closer to prime than further away. Okay, because it's the risk. Right, so a home loan would have a lower cost of capital than a credit card. Okay, because the home loan has collateral and the credit card doesn't. Okay, so when we look at cost of capital, we're not focusing on what is the company using in terms of debt and equity. We're looking at what is the company going to be spending on their debt and equity. Okay, so here's the first example, company A. What does the project cost?
1 million.
Good. So where is that going to come from?
From your debt to your equity.
Good. See, that's important. Okay, so you know that the 1 million can either come from your debt or your equity. How much is this 1 million going to cost us?
I'm not sure.
It's there.
12% of 1 million.
Oh, okay.
How much?
12% of the 1 million.
Correct. 12% is the cost for the 1 million. Does that make sense?
Okay.
Okay, so do you
Yes.
agree?
Okay, yeah.
12% is the cost of raising capital. It doesn't matter where it came from, debt or equity, that's irrelevant. Okay, if I look at the cost, it's going to cost me 12% to finance that debt or equity. Still with me?
Yes.
Yeah.
Okay, so what's the benefit?
It's less than the
The benefit, what's the benefit?
required. It's less than
So
the
this is not return.
The benefit is 14%. Do you agree?
Yeah.
This is the benefit, this is the reward. What is the cost?
12%, and then so it's greater than the reward is greater than what you have to pay.
Okay, so is this a good project?
Yes.
Yes.
Yes. Are we going to accept it?
Yeah.
Yes.
Yes. Okay, so we would accept A because the cost is less
It's lower
than
than reward.
the reward. Will we add value?
Yes.
Yes.
Yes. Okay, so that's the important bit in terms of decision making. Right, you guys do B.
This one we will reject
Why?
because
Your reward's
the
less.
Good. How much does it cost you to accept the project?
18.
18%. Okay, so if I had to raise debt and equity, it doesn't matter what the mix is. Okay, we'll look at calculating that later. For now, I'm just looking at how much will it cost us to raise 2 million in the market. It's going to cost us 18%, right?
Yeah.
What project are we going to accept? A project. Okay, and how much does the project yield?
16.
Correct. So, accept or reject?
Reject.
Correct. Okay, you're not going to go ahead with this project. You're going to put the project on hold. Okay, when would you accept this project in terms of financing?
If the IRR is greater than the cost.
Yes, so if you can find capital that's less than 18% in terms of its cost, will you now go with this project?
Yeah.
Yes.
Yes, and see, that's what financial managers do. They look at seeking finance. They're looking at financing those projects. Okay, because remember, a company is going to have different departments. Okay, so the financial manager's role is to find the cheapest form of financing to ensure that the business can operate.
Fine.
Okay. Alright, so accept or reject it? Definitely reject, because IRR is less than the cost of capital. Right, so do we consider long term or short term?
Long term.
Why? Why long term?
Because that's what FIN3701 is all about.
And besides that, what assets are you buying?
Non-current.
Exactly. Okay, so you're purchasing non-current assets. Okay, you're investing in long-term projects. Okay, so we spoke about replacement versus expansion, right? What was that focusing on? Your capacity to operate, your assets. Okay, so are we going to expand? Are we going to buy a new machine for the business? Is that new machine going to generate more or less value for the company? Okay, we're looking at that. We're looking at financing new assets, expansion or replacement. Assets give us capacity, and that's considered long-term. Okay, so you're also right for saying that this module is focusing on long-term, because the other module focuses on the short-term. Okay.
Yeah.
So financing method, okay, supports the company's fixed assets. See, there's the answer. What do fixed assets provide the business with? Capacity.
Capacity.
All right, so if you're buying more machinery, good or bad decision?
Good.
Good, as long as that machine is going to be generating income. If you're going to be taking out loans to pay for expenses, good or bad?
Bad.
Why?
Because you need to take out loans to actually generate income.
Okay, yeah, you're taking out a loan to pay for an expense, so you're financing your operations. You're not increasing your capacity. Does that make sense?
Yeah.
Yeah.
Good. Okay, so always focus on long term. Long term is looking at the benefit that we can derive over a long period of time. Not short term, but long term. Okay, it's longer term. So we look at the end goal. Right, we're not looking at now. Okay, so the situation now could be very different to what the situation is going to be in the next 5, 10, or 20 years. If we're not making good decisions today in terms of what we're financing, is the company going to grow?
No.
No. Okay, so the company wants to finance this. Fixed assets. Because the more the company has, the more the company can grow because then value is being created. Right, so where would we get the information from?
Statements of financial position.
Yes, okay, you could look at it there because you'll see what? The owner's equity and the liability. Okay, those are the two that I'm focusing on. Or you could also look at the statement of changes in equity. Okay, because that'll tell you about the equity, right, specifically. Right, so the best place would be what you said earlier, which was the statement of financial position. Right, so give me some basic sources of funding.
Long-term debt.
Good.
Preference shares.
Preference shares, yes.
Ordinary shares.
Good.
And retained earnings.
Retained earnings, what else?
You asked before.
Okay, basic sources of funding. Okay, so if you think about others, what could there be?
All sales and services, depending what your company also does.
Okay, that's not a source of funding. The creditors would be a source of funding. Okay, because creditors finance your business, right?
Yeah.
Okay, if you've got good creditors, if they've given you nice terms, what does that mean? Well, I can buy today and pay later. Is that a source of funding?
Yeah.
Yeah.
Yes.
Yes. Okay, so if you can get stock from a supplier today and only have to pay for it in 60 days, well, that's brilliant because now for 60 days I can operate and I only need to make payment on day 59.
Yeah.
Good. All right, so other forms of funding besides these, creditors is one. What else?
Well, loans.
What loans?
Bank loans.
Short term, yeah, or bank loans. You could be more specific, okay? You could specify different types of loans. But yeah, so in terms of sources of funding, okay, long term versus short term, they're all sources of funding because they're going to help the business operate. Okay, they're going to be helping the business to contribute towards its towards the actual shareholders, so the company's owners. Right, so you mentioned sales earlier, Carl. We could put that under which heading here? The long-term debt, the pref shares, the ordinary shares, the retained earnings.
Sorry, say that again.
Where can we put sales? You mentioned sales earlier from selling income.
Well, that'll go under your shares.
No, it wouldn't go under the shares.
Long-term debt.
Long-term debt, no. What does income affect?
Retained earnings. Retained earnings.
It affects your retained earnings, that's right. Okay, because retained earnings is how much of it do you keep for your business and how much of it do you pay to the owners.
That's shareholders.
Alright, so do you guys remember what the difference is between after tax and before tax?
Well, after tax is when tax is already deducted.
Yes, so you need to remove tax from the cost of debt. Okay, so what form of financing am I looking at here? What form of finance, guys?
What do you mean?
Debt or equity?
Equity.
No, cost of long-term debt. Which form of financing? It's the loans, the liabilities. Do you agree?
Okay, I didn't get your question.
Okay, right, so here I'm looking at the cost of long-term debt. This is the first form of financing. What cost am I going to be looking at before or after tax?
Sorry, say again.
Before or after tax, which cost am I going to be looking at?
What is that, before tax?
After tax.
Liabilities, I mean.
After tax,
After,
because it's a relevant cost. Okay, so these are the key words that you need to remember when looking at what? Debt. Always consider the after-tax costs. Always consider the net proceeds. Net proceeds means what do you get after having issued the bonds? Okay, so what am I going to do to flotation costs? Will I minus or add it? Add or subtract?
Minus.
Correct, you will subtract. Because net proceeds means what do you have left over? After you've raised the capital, how much are you actually going to be utilizing in the business? Make sense?
Yeah.
Yeah.
Good. Now we've got the time value of money. So here's a revision note from FIN3701. Do you remember how to calculate bonds?
Yeah, it's basically the same as in NPV, and you kind of treat it the same.
Well, it's similar, yes. Okay, so now we need to talk about what do these terms mean. So let's see how much of FIN3701 you guys remember. What does the N represent?
The N, sorry?
What does the N represent? The period.
The years.
The time, the years, yes. What does the I represent?
Interest.
Good. The rate, which is called?
Yield to maturity.
Yes. Okay, because we're talking about bonds. We're talking about debt. Okay, what is the payment representing? Do you guys remember?
The cash flow.
What is the cash flow called for a bond?
Par value.
Par value, no. What's the cash flow for a bond called?
Coupon.
Yes, the coupon. Yeah. The coupon. Okay, the coupon comes from the coupon rate. Do you agree?
That's the cost of a bond.
That's the cost, yes, because that's the interest you're paying. That's the nominal cost, not the effective cost. Remember, there's a difference between nominal and effective rates. Okay, what's the future value?
But it will be 1 day.
which is what for a bond?
Face value.
Face or par value. See, that was what we called it. Okay, and then PV is what? The easy one. The bond price or the bond value.
On the price. There you go.
Okay, do you agree?
Yep.
Okay, so let's see if you guys remember how to do this. I've asked you a few questions here. I've answered the first one. Okay, how do we value the bond? We discount future cash flows. What are the future cash flows? Coupons and the face or par value. Okay, I want to know from you guys, what would the cost of debt be? What is the cost of debt?
Interest.
Yes, the rate, the I. Okay, so the I represents the cost of debt because that's the yield to maturity, which is what you actually end up paying over the life of the loan. So how do I calculate this?
With your calculator.
Exactly. Identify variables, substitute it into the calculator, and get an answer. Okay, so I want you guys to work out the cost of the bond here. What's the cost of capital for debt here? See if you can work it out. Grab the calculator, substitute and solve.
For the coupon, must we put the percentage in the calculator?
You tell me, what do I put in?
I can't remember.
Think about it. What is the coupon?
It's a payment.
It's a payment, yes. It's a percentage of what? The
The
coupon
cost.
is a percentage of what?
The cost.
The par value. Remember, how do you get the coupon?
You times the 9% by the 1,000.
Yes. Okay, percentage of par is the coupon. Once you've got the coupon, you know what the payment is. Did that help?
Yeah.
Tammy?
Yeah, I think so.
Okay, so now work it out.
20 years.
Any answers yet?
No. I can't get it.
Carl?
1,000.
Any
I
answers
got
yet? Did you get
8.9. Is it 8.9?
8.9. Not quite.
Yeah.
Okay, so give me variables. Okay, you tell me what the variables are.
Okay, well the n's 20, that's easy to understand.
Okay, so n is 20. Fine. Happy with that.
Alright, your PMT is 90, if you worked out.
Good. PMT is 9% of 1,000, which is 90. Good.
Alright, 1,000, that's your future value, correct?
Yes. Good.
Or your, yes, okay. And then the provides for 960 today, is that your present value, the 960?
Yes. Good. Do you have all the variables? How many variables do you need for a bond calculation?
Okay, then
Four.
it's, well,
Yes. You need 4 of the 5 variables if it's a coupon bond.
yeah, I actually put the present value opposite on the calculator, so I got 9.4.
Good. Yes. Did you get that as well, Tammy?
No, mine says no solution, but I think I forgot to put the negative in.
Probably. Try again.
No, okay. 20 in 90 payment, 1,000 future value, 160 negative present value, I 945 before.
Yes, okay, so 9,45. Okay, that's the percentage cost of the bond's capital. Do you agree?
Yeah.
Great. Okay, so come, you guys do these two, example 2 and 3. Okay, Tammy do 2, Carl do 3. Right, but do both though, but I'll ask you guys to help me with each of them. So Tammy will help me with 2, Carl, you can help me with 3. Okay, but work them both out yourselves, and then we'll check.
Okay.
Alright, do you guys have the answers?
Yes.
Almost. Okay. Try get both and then we check. Finish the last one that
Oh
you're
no, I
busy
haven't
with.
started with the second one yet.
Okay, come quickly, type it in and solve.
Oh, man.
I know.
Alright, Tammy, so you just busy with the last one.
Yeah, sorry, just hold on 1 second.
Okay.
It keeps on. Oh, I forgot the negative. Okay, I got it.
Alright, so let's check, guys. Okay, so number 2. What did you get, Tammy?
10.2670.
Good. Okay, yeah, so if we round off 10.27, happy with that. What did you get, Carl, for the third one?
13.36.
3.6. Good. Great. So there you go. You guys can do these calculations using what? Time value of money applied to bonds. Okay, so do you agree? If I had to raise 1 million in the first example, how much is it going to cost us? 10.27%. That's the cost of raising the 1 million in the market. Does that make sense?
Yeah.
Good. Alright, so let's continue where we left off. There's the trick. The trick is identify the variables and solve for which one?
I.
Correct, because that represents the before tax cost. If you want to work out after tax cost, then I just need to take off the tax. 1 minus the tax. Got it?
Yeah.
Good. Right, so let's change focus. So now, what form of capital do I have here?
Preference shares.
Yes, okay. Preference shares are special because you're going to be receiving a dividend, okay, but you have to pay because it's preference shares. So there's almost like an obligation to pay the dividend. So it's viewed as quasi-debt because it's seen like debt, okay, but also similar to equity. Because is there a maturity date? Do the preference shares end in terms of their, like for example, a bond or a loan? A loan will end at some point in time in the future once it's paid back. So does the same thing apply here?
No.
No. Okay, these shares can last forever. As long as you've got the preference shares, you will be getting a preference share dividend. Right, so are dividends paid out before or after tax?
Before, after.
After tax. Why after tax and not before?
Because,
Where does the dividend come from, guys?
from equity.
Not from equity. Where does the dividend come from?
The company.
From the company. And which companies will pay out a dividend? Companies that have what?
No, that make a profit.
Exactly. Yes.
Make money.
Okay, so good. So the key there was companies that make a profit pay out a dividend. Okay, that's why you'll be considering after tax, not before, because it's a share of the profit. Right, so how do I measure a preference share in terms of its cost? I need to determine what it is. Okay, it has a specific formula, right? There's the formula for a cost of preference share. It's similar to a perpetuity. Okay, so if you guys have done some more of the financial math, then you would have seen a perpetuity. A perpetuity is a never-ending payment. So, is this ever going to end?
No.
Okay, so we have a perpetuity because it doesn't end. Okay, remember we saw that in 2601 where you had an amount that kept recurring, that doesn't ever end. So PV equals payment over I. That is the formula that you guys are familiar with from the previous module. What they've done here is they've just taken that formula and they've derived a new one. I equals payment over PV. So is that the formula for calculating the pref share cost of capital?
Yes.
Yes. Okay, because we're looking for the I's. Okay, I is the subject of the equation. I is the rate that I'm trying to calculate. Happy?
Yeah.
Good. Alright, so let's see if you guys would be able to work this out. Okay, I'll help you with the first one. Let's talk about the different values that we need in order to calculate the actual answer. Okay, so what is I equal to? I equals what over what?
PMT over PVV.
Present value.
Correct. So what is the payment?
£5 per share.
The payment. What is the payment?
£5 per share.
No, the payment is the preference share dividend. Remember, it's the dividend.
So is it because then sold at 87 rand? So then it's 87 rand, is it not?
No, that's.
Wait, hold on. Company has 10%.
Okay, what is the 87 rand? That's the price of the share. So from the information, what's the dividend? What's the payment?
10%
Yes, of what?
of the 87.
Yes. That's the payment that you're going to be making. Okay, and then we need to look at the cost of the pref share. So what is the cost of selling the preference share?
£5.
5. So
No.
what are the net proceeds?
The 87 minus 5.
Yes. Okay, good. And work that out quickly for us. What answer do you guys
I
get?
don't have a calculator for it.
Hey?
It's difficult to do it on this calculator.
Do you have the other one?
No, not with me.
Okay. So then do it in 2 steps. Type in 87 minus 5 equals what? What's 87 minus 5, Tammy?
82.
Yes. And then do a separate
Okay,
calculation.
output.
0.10 times 87 gives you what?
Okay, I already got to 10.0698.
Okay, there you go. You've got the answer. Right, did you also get that, Carl?
No, I tried on my calculator, but yeah, it doesn't work.
Try again.
Gotta use my other one. Yeah, see another one, I get it. 0.106097, so.
Yeah, that's the decimal. To get a percentage, you would just times it by 100 to get the percentage. Is that alright?
Yeah.
Good. Okay, so you guys do these two. Example 2, next one. Work it out quickly. What is the cost of pref shares here? Okay, what did you get, Carl? What did you get, Carl?
Oh, no, wait.
Carl, are you still there? Carl, what did you get?
Well, I got 8.4 because I rounded it off, but it's
Okay.
8.35 and rounded off to 8.4.
Okay, good. Okay, so yeah, so both of you got the right answer. Maybe it's just the rounding that gave you that one.
Yeah.
Oh, no, but I accidentally said 95 minus 5. I was still thinking of the previous one.
Oh, okay, no. In this question, it's minus 4 because the cost of selling the pref shares is 4.
Yeah, I got it now.
Okay, good. Next one, guys. Do the next one. 3. Did you get the same thing, Carl?
Hold on, I'm just checking something here. Yeah, 0.1565, so 15.65.
Okay, 15.65, yeah, or 66, depending on how you round off. Good. Okay, last example, next one, number 4. See if you guys can work that one out.
I'll get 12.18.
And Carl? Same as Tammy
Yeah, the
or
same.
not?
Yeah, the same.
Same. Okay, let's check. Oops.
Yep.
Wrong button. Yeah, 12.18, perfect. Okay, there you go. You guys got it. Right, and that's how you would calculate the cost of what form of equity?
Preference shares.
Good. Okay, so now, number 3. Changing focus again. Third form of financing, ordinary shares. What's special or unique about this? Well, there's no end in terms of the time frame. Okay, because they hold those shares indefinitely potentially if they wanted to. Right, so there's two forms of financing. You get retained earnings and you get new shares. Is there a difference here?
Yes.
There is a difference. Okay, practically, retained earnings is very different to a new issue of shares. But when we look at the theory, you'll see I've got a note about this later. We'll discuss it. Okay, we'll relate the retained earnings to the issue of new shares in terms of its costs. Right, what am I going to need to know here in terms of workings? Well, again, a little bit of revision from 2601. You need to know how to use Gordon growth. You need to know how to use CAP-M. And you need to know how to discount dividends. Those are the three different techniques that help us to do what? Find the cost of ordinary shares. Here's the first one. Constant growth. Gordon growth. What do I need to do the Gordon growth model? I need a formula. Before, you guys are familiar with this. That looks familiar, right? Div 1.
Yeah, Div 1, RG.
Div 1 over R minus G, right?
Mm-hmm.
You should recognize that. Present value equals that. So what the textbook has done is they've taken that formula and they've derived for R. They've made R the subject of the equation. So if you do that, you get that formula there. Okay, so you can decide how you want to do it. If your maths is quite good, then you can just remember the Gordon growth formula, substitute and solve and get the right answer. If your maths isn't so good, then just remember this formula. The rate equals div 1 over the price, close brackets, plus the growth. So let's see if you guys can work this out. Here's the question. We're looking at company X. We want the share price. Okay, not the share price. We've been given the share price. We want the cost of equity. Okay, so give me variables.
So we're solving for the PV.
No. What are you solving for?
For ordinary shares.
For the R.
Equity.
The R. The cost. The cost. Hey guys. Not the PV. The cost. Do you agree?
Yeah.
Okay, so what's the dividend? What's the proceeds? And what's the growth? Dividend, guys?
Right. It's 5%.
No, that's the
4.
growth. Dividend, Tammy?
4.
Yes. Proceeds?
That's the 50 rand.
Growth?
And then the growth is the 5%.
Correct. So what do you get as a final answer?
I don't know yet. It's 8,4.
Do you agree, Carl?
I got 0.13.
Yes, so did I. Okay.
How?
Remember, it's a percentage. Okay, so you're adding 0.5. It's a percentage.
4 divided by 50 equals plus 5%. No, why am I not getting this?
What are you typing in? Are you typing in 5%
divided-
or 5 as a fraction or a decimal?
5 is a percentage.
Okay, so it's 0,05. If you're using decimals, use decimals. Okay,
Okay, then I'll
0,13
get
is
to-
the same as 13%. What are you typing in? Tell me.
Well, I said 4 divided by 50.
Yes. Plus.
Then I said equals.
Okay, fine.
Plus.
Equals what? What does that give us? Equals what?
I don't know. I went back now. 4 divided by 50 equals 0.08.
0.08. No, that can't be right.
Yes. 4
divided by 50.
Well, I promise you my calculator says 0.08.
Oh, okay, that's fine, because 0,08 would be what? 8%. Okay, that's fine. Okay, because then 0,08 plus 0,05 gives you 0,13. Yeah, so that is fine. Okay, so that is fine. That does give you the right answer then.
Okay. But the thing is, if I said, okay, equals, and it said 0.08, I just said plus 5 as a percentage.
No, you can't add a percentage to a decimal. You have to add a
Okay.
decimal to a decimal or a percentage to a percentage.
Okay.
Okay, so you had 0,08, which is how much percent? 8%. Do you agree?
Yeah.
Okay, so if you times this answer by 100, then you can add 5 to it, because then you'll get 8, and then 8 plus 5 is 13%. Is that alright?
Yes.
Okay. Try this one, guys. Cost of equity. What is it? Any answer yet?
No.
I got 6.8.
Okay. Do you agree?
Right. Yes.
Right. So if I take 7 and I divide it by 250 and I add 0.04, I do get 6.8. Correct. Well done. Alright, so now we're looking at the next technique. Okay, remember we're still focusing on ordinary shares. We're just looking at another technique to find what? The cost of equity. So do you guys remember what CAPM stands for?
Capital, I don't know. Yeah, capital asset price model.
And what does it describe? The relationship between what? Risk and return. Do you agree?
Okay, well,
Do you agree?
yes.
Okay, so if I'm looking at CAPM, CAPM is a measure of costs based on beta. Beta is the risk. This is the risk-free. And that's the market return. Okay, so more of the CAPM formula. All right, and that gives you a required rate of return. which we'll view as the cost of equity. Does that make sense?
Yes.
Okay. So let's see if you guys can still remember how to use capping. I gave you the formula.
Hold on, Anthony, just go back quickly for 1
Yeah.
second.
Okay, any other questions about this?
No.
Remember to make a note what each of the variables mean. Okay, so you know how to substitute the amounts in.
Okay, you can carry on, Anthony.
Okay, here's an example. Let's see if you guys remember how to use CAPM. So use the formula to calculate the required return. The required return is going to be representative of the cost of equity. See if you can do that.
I've got 13%.
Okay, and tell me, what did you get?
I'm so busy.
It sounds like are you looking after your son again today, Carl?
No, he's just around.
Oh, he's just around. Okay, I thought you were looking after him again.
Making
today.
noises. Nah, he's making noises.
Right, tell me, what did you get?
Okay, yeah, 13. Yeah, 13%.
Correct. Okay, so that's what you had to do. Take the formula, write it down. Substitute what you know and solve for the unknown. What does that represent? The cost of this particular company's equity. Okay, because it's based on what measure? It's based on the risk. Okay, so beta gives us the risk that's inherent in this particular asset or company. Okay, so that's another way of determining value in terms of the actual rate. What rate am I going to consider? Does that make sense?
Yeah.
Good. Right, so now do the same thing for company B, and then I want you to compare the two.
The only thing is it's horrible with this calculator. I can't do it.
Which one?
This HP.
The HP. Okay, so obviously you'll have the other scientific with you in the exam. Okay, maybe try bring both or keep both with you next week as well. So at least then, if you do have any, let's say, more scientific type of calculations or more algebra rather, then you can rather use that one. Okay, for now, yes, the HP is not so great in terms of user interface. It's probably one of the more difficult calculators to use when doing normal mathematics.
But I've noticed the calculator is so much easier to use with everything.
Yes, it is.
Let me see if I can do it on my phone.
Okay, give us the variables. Tell us what you're typing in so we can check. What did you get, Carl?
Hold on, I'm just rechecking because the number was quite big, so I'm just making sure I don't make a mess up somewhere.
Both do it again. Check and then check.
Yeah, there we go. I got 17.8%.
All right. Okay, so we've got a figure to work with. Now we need to check yours.
Okay, just give me 1 second. No, I can't do it. Wait, let me just try again. 7% plus 2.7 bracket 11% minus 7% bracket. No, my calculator gets to 0.34621.
No, okay, something's wrong. You're typing it incorrectly. So maybe rather just use the scientific when you get the scientific, just so you can do the working again. Okay, but you had 17.8, Carl?
Yeah.
That's correct. Okay, so just be careful how you're typing it in, Tammy. You're doing it incorrectly. I think you're leaving out something or you're adding something extra. But yeah, do it on the scientific, not on your phone. Rather use that calculator. You'll probably get the right answer.
Let me just try something again. Okay, now I get it. If I type it in as decimal, as the percentage, it doesn't work out.
Okay, so then maybe stick to decimals, yeah. Alright, just find what works. Okay, you can use either or. You can use percentages or decimals, it doesn't matter what you use. As long as you're getting 17.8, if you got a decimal, the decimal would have been 0.178.
Yes.
Still the same answer. Okay, so what do you guys notice? The first one, 13. The second one, 17.8. Talk to me. Company A versus B. What do you observe?
The cost of equity. Well, B, the cost of equity is far greater.
Good. Okay, so company
Then
B has to pay more on their equity if they raise capital. Good. What else? What else do you notice?
Beta. What was beta again? What does beta stand for?
Beta is a statistical value that comes from stats. Okay, so you do some workings based on the data, and you get a measure of risk. Okay, beta is just a measure of risk.
Okay.
You don't have to worry about how to calculate
so
it. It will be given in the question.
Yeah, no, just because that's the only thing that changed in the calculation was
Correct.
the beta.
So what is
the risk.
that? What is that telling us? You're right.
The risk.
There's more risk, yeah.
Yes, the risk has increased. So if the risk increases, so does the cost of financing that project. Okay, great. Well done. All right, so just a note over here about the two models. Which is better? Do both incorporate risk?
Yes.
No, they don't.
No, one only is talking about... Yeah, it only talks about the growth and the proceedings. So CAPM is actually better because it brings in all the risk and everything.
Exactly, yes. CAPM is what's preferred because Gordon growth looks at what you think will happen in the future. What I think the growth is, what I think the dividend is, what I think the rate is. Okay, the CAPM gives us a measure of risk as part of the actual formula. So it incorporates it as well. Alright, so in terms of theory, CAPM is preferred because it has more, let's say, advantage in terms of being stronger from a theoretical point of view. Do both methods incorporate risk? No, only the one does. Right, so we need to discuss this again. Earlier on you saw it, I'm going to expand on it now. Is the cost of retained earnings the same as the cost of ordinary shares? When I say ordinary shares, I mean issuing new shares. Would you equate the cost as being the same?
No.
No, you won't. Okay, in reality, you won't. Okay, but when it comes to theory, let's think about this. If I don't have retained earnings, what must I do?
You need to issue more shares.
Correct. Okay, that's important. Right, so it doesn't matter if it's retained or if it's issued new. Okay, when we approach a question, according to Miller and Modigliani, from the theory that they've uncovered in terms of the way companies are financed, companies aren't going to be, let's say, what's the right word? They're not going to be penalized if they choose to use more debt or equity, or if they choose to use retained earnings or ordinary shares. It doesn't matter what they use. Okay, are these costs the same? In reality, they're not. But when it comes to theory, we assume they are, because if I don't retain, I pay out. And if I pay out, I need to issue new shares. Okay, so our flotation cost a factor? Yes. For which one?
For
the
ordinary
new
shares.
Yes. Okay, so see, that's also something to consider. So you could look at different rates if you wanted to, but then they've got to give you more information. Right, the point I want to try and make here is normally you can assume that they're the same unless they give you specifics in the question that would make you think that the one is slightly different to the other, like the flotation cost. That can make a difference. Right, so let's look at that. The new shares. Are we going to look at flotation cost if I'm issuing new?
Yes.
Yes, I will. Right, and another debate about this is also when you sell new shares, you need to make it attractive to the market. Okay, no one's going to want to buy new shares in the market at more than what the price is. But people will be willing to buy more shares in the market if the price is slightly less. And that's why when issuing new shares, that could also be a consideration in terms of value. Like you might not be able to realize as much from it. Okay, that creates a problem in terms of the rate. Okay, because we're trying to determine the rate of equity, the cost of equity. So this formula looks very similar to which one?
That Gordon growth.
No, the preference share div one. Okay, remember the preference share div one looked similar? Okay, it was the dividend over the end. Well, actually, you are right if you think about it, because there was growth in dividend growth as well, in Gordon growth as well. Okay, so it actually looks similar to both. Okay, so when looking at the cost of equity, looking at this particular example, we're going to be focusing on what? The debt or the equity? The dividend or the equity, sorry. Dividend or the price? What am I looking at? I'm looking at the dividend and the price, and that gives me the value that I need to add to the growth. Is that alright? Are you guys still there?
Yeah.
Okay. Alright, then we've got a note here about the WACC. What does WACC do?
It's your weighted average cost.
Okay, so what did we say earlier? What is the capital structure of a company? What is that, guys? Capital structure is what? Percentage of debt and percentage of equity. Do you guys agree?
Weighted average cost of capital.
Capital structure.
Okay.
So with the weighted average cost of capital, we're focusing on those two components. Do companies choose their debt and equity?
Yes.
Yes, they'll have a percentage of the one and a percentage of the other. So if we're looking at the cost of debt and the cost of equity, if I use more debt, then the weighting is going to be more for debt. And if I use less equity, the equity will be less. Okay, so when looking at the WACC, here's the formula for WACC. Weighting times the debt plus weighting times the pref share plus weighting times the ordinary. And you could have other forms of capital as well. If you have multiple forms of capital, you'll have multiple weightings, a percentage of. Right, all of these weightings need to add up to what? 100%.
1 over.
Okay, because think about this. If you've got 60% debt, what is equity going to be?
40.
Yes, it's automatically 40 because the total makes up the value of the business. Got it?
Yes.
Good. Okay. So when doing a calculation, here's the first example. Okay. I've given you cost of debt, cost of pref shares, cost of retained earnings, and cost of ordinary shares. Where would this have come from? The bond calculation. Okay, so now, remember earlier on we did the separate calculations?
Yeah.
And what did I work out? I worked out the cost of debt. And then remember earlier I worked out cost of pref shares? Okay, so all of that is going to be combined as part of your weighted average cost of capital, which is the total that your company is going to have in terms of all its different components of equity and debt. Okay, there are the weightings. Alright, what must I remember with debt? Do I use before or after tax?
After.
Exactly. So what is the tax here?
28%.
Correct. So how do I get the after-tax amount? 6,6 times what? 1 minus the 28%. The tax, yes. And see, that gives me the after-tax. Okay, how much of that is coming from debt? Or how much of the total is coming from debt? How much, guys? 40%. Okay, so there's the weighted average cost of capital, okay, using the 40%, the 10%, and the 50%. Notice, the only one that we need to take tax off is this one here. Okay, so there's the weighting. What is that representing? That's representing my debt. Okay, what is this representing?
Equity.
Yes, the pref shares. Okay, pref shares, not equity, pref shares. Alright, that's representing the pref shares. Okay, so what is it? It's the cost times the weighting. Right, and then what's this last bit representing?
Ordinary.
Yes. Okay, that's representing the ordinary share. Okay, there's the thing. Right, but what did I give you in this question? I tried to show it here because I've showed you that there's a slightly different cost. If you think about it, retained earnings is the cheapest form of financing, right? Because you don't have to raise capital. It has been created already. If I issue new shares, do you think the cost will go up or down? Correct. The cost of issuing new shares will go up because it's more expensive to issue new shares than it is to take from the retained earnings. Right, so I've shown two workings here where I've used this as the cost of equity. Alright, so do you agree, if I look at this, the weighted average cost of capital is going to range between what? 9.46 and 9.96. That's the scope in terms of the cost of capital. Does that make sense? Okay, so when looking at WACC, this company's WACC is going to range between 9.46 and 9.96. That's how much it would cost this company to raise capital in this weighting, in that weighting. Okay, so let's just summarize that. Okay, again, one more statement just to summarize and wrap up this example. If I choose to raise capital through debt, equity, and pref shares, okay, so all of those. If I use that weighting, what is the actual cost of capital? Well, the cost of capital is going to be a weighting of debt plus a weighting of pref shares plus a weighting of ordinary shares. And that weighting comes out to that amount, 9.46 and 9.96. That's the total that I can expect in terms of the cost for this company to raise capital. Makes sense, guys? Are you still there?
is the top one is for retained earnings and the other one is for new ordinary shares.
Yes, but they're both a measure of costs for the company. Looking at the weighting, 40, 10, and 50.
But now, why do we only times the debt by the tax and not the preference and the ordinary shares?
Okay, good question.
The preference and ordinary shares are after tax, eh?
Yes.
They're given after... Okay, yes, no, I understand.
Okay,
tax, that's before tax and then... Okay.
Dividends are paid after tax.
Tax, also, okay, cool.
Debt is tax deductible. That's why we take it off. Is that alright?
Yeah.
Good. Okay, so you guys do example 2. I want 2 measures, okay, for WACC using that information. See if you can do that. Guys, do you have an answer yet? How are we doing?
Not yet.
Still busy? Remember to write down the working. The working is important because you've got lots of different components here, hey?
Yeah.
Okay, so make sure you've got the working. That helps a lot. Any answer yet? Not yet.
8.58.
8.58. Carl? You should have 2 answers, hey, Tammy? Because you've got retained earnings and new shares.
Yes, I'm busy with the second one.
Okay. What did you get?
9.18.
9.18. Okay, so we've got 2 answers. Carl, how are you doing there?
What is the... I got 8.5% for the first.
Yes.
Okay.
Well done. You guys had the right answers then. Okay, so looking at that, what does that tell me? That tells me this company's weighted average cost is going to range between 8.58 and 9.18. So when would I accept projects?
Not sure.
Well, what is this representing?
The cost.
Exactly. So when will I accept projects?
The cost is lower than the return.
Yes, so I'll accept when the return, okay, is greater than 9.18. Because any project that's greater than 9.18 is going to cover the weighted average cost irrespective of which form of equity I use, the retained earnings or the ordinary shares. Does that make sense?
Just hold on.
That's your cost. Okay, so any return greater than the cost would be positive, we would accept. Happy, guys?
But what if the return was greater than the cost for the retained earnings?
If it's greater than the one and less than the other, then it's in the middle. So if you are using retained earnings, then that would be fine. If you weren't, then you couldn't say so.
So, but what's the point of calculating both then if the ordinary shares is more than the retained earnings?
Because it gives you 2 different scenarios. Scenario 1 is if I use the cheaper financing. Scenario 2 if I use the more expensive.
But it can be swapped around, hey?
If it's swapped around, it's still the same thing. It's still going to be 8.58 and 9.1.
Okay, so it's not always that the
it doesn't matter which way you worked it out. You could have worked out the first one, or you could work out the second one first. It doesn't matter which one you worked out first.
Yes, I understand that.
But
I don't know what I'm actually asked or how to ask what I want to know. But it is possible that the new ordinary shares can be less than the retained earnings. It is possible.
Oh, okay. You're asking, can this be lower than that?
Yes.
No. Okay, because retained earnings is the cheapest form of financing. In terms of theory, they're actually going to make these two the same. Okay, I don't like making those two the same because with ordinary shares, you've got what? Flotation costs, share issue expenses.
Okay.
So because you have flotation costs and you've got other expenses, it increases this cost. So retained earnings will always be the lower of the two.
Okay, but then you might as well just work out the cost of new ordinary shares.
Yes, because whatever the project is, if the project is greater than that, I'm definitely creating value.
Okay, but then we don't have to work out the first one.
You don't, but I've done it just in case, because in the exam we don't know what they want. You need to do as much as you can with what they give you.
Okay.
Alright, so I'll discuss that later when we look at past papers. Okay, remember, we've picked up mistakes in the past. The newer exams are much better. So when we do look at the older ones, I'm going to say that again. Don't worry about what was given, okay? Do as much as you can with what they've given you. So if you can work out another whack, work it out. It's safer to work out more rather than to work out less. Okay. Alright, then you've got a note here about decision making. That's what we spoke about earlier. If the expected return is greater than the cost. Okay, so if the reward is greater than the cost, what do?
Accept.
We accept. Alright, then they talk about EVA, which is a working, economic value added working. It's a static approach because it's looking at value that's being created. Okay, is WACC going to change over time?
Yes.
Yes, it will. Right, so how can WACC change over time? Well, let's think about this. Are resources limited or unlimited?
Limited.
Limited. Can I get capital from more people?
Yes.
Yes, I can. But the more people I ask for capital, the more expensive it's going to get. Because the cost of raising more finance will increase.
Yes.
And that's why you've got something here called the weighted marginal cost of capital. This is looking at the relationship between your cost and your return.
Right, we lost you there.
Okay, this is looking at the cost and the return. That's what the marginal cost of capital is looking at. It's looking at how much is the cost now versus how much will the cost be in the future. Okay, will that cost change?
Yes.
It will change because what did we just say? If I approach more people for loans, they'll give me more loans, but those loans will get more and more and more expensive. Okay, and that comes to the end of this one. Okay, just a note here about the WMCC, weighted marginal cost of capital. There's a really good past paper that I'm definitely going to cover with you. There's a question that looks at WMCC, and we actually draw a graph, and we discuss the increasing and decreasing in terms of the weighted average cost of capital, and we look at the IRR, which is the return that we get. Okay, just remember, you need to always consider the cost versus the reward. Okay, and the cost comes from what? The debt and the equity. Depending on what percentage you've used of each will determine what the cost is going to be for your company. Make sense?
Yes.
Alright, great. And that's it for this week. Right, so if you can, try and look at some of the examples in the study guide and the textbook as practice. But we will look at the assignments soon, and then obviously at a later stage we'll be looking at the past papers. Do you guys have any questions?
No.
No.